Hey, how's it going? Bill Lethman here for Money Evolution. In this video, I'm going to be talking about how to manage your retirement withdrawal bucket strategy. So if you're somebody that's getting closer to retirement, or maybe you're already in retirement and you're looking for a way to create that retirement withdrawal plan in a way that's going to be able to accommodate your cash flows in retirement throughout all the different phases that you're likely going to go through in retirement, then you're in the right place. I think you're going to get a lot of value out of this video. But real quick, before I get into the content of today's video, if you're watching this and you'd like to learn more about what we do at Money Evolution, you can head over to moneyevolution.com. Check out some of the resources that we have there. We're building out an entire financial education hub that's going to cover all kinds of different topics from retirement planning, tax strategies, personal finance, and a whole bunch more. So moneyevolution.com, and we'll put some links down in the description below. So let's jump right in. Let's first of all talk about what is a retirement bucket strategy. This is something that maybe you've heard of before, maybe you've heard this term, maybe you already kind of know a little bit about how it works, or maybe this is a brand new concept to you. But either way, I think the way that I'm going to outline it here, I'm going to lay out some rules and some ways that you should be thinking about this bucket strategy as you go through retirement. And how do you manage that retirement bucket strategy, and what do you do, and when do you refill buckets? And we're going to get into all of that here in just a minute. But let's first talk about what is the bucket strategy. Well, the bucket strategy is really a way to sort of think about separating some of your financial assets and really start to prepare for when you're going to start to need some of that money out of your retirement portfolio to cover some of those retirement cash flow gaps. And so rule number one is really to know what your gaps are. And this is something that I've talked about in many other videos. This is something we do with our comprehensive financial plans. It's also something we do as part of our retirement time machine program, where we help to build out an entire roadmap, essentially, of looking at what your retirement's going to look like, what money's coming in, what are the gaps, what are the taxes that you're going to have to pay throughout retirement. And so, sort of a shameless plug on that. If you'd like to learn more about that, we've got some links down in the description below for those programs as well. But however you do it, whether it's through one of our programs or another financial planning tool, or you're just doing it on a spreadsheet, you need to have that map, because one of the things that people may not necessarily realize as they go into retirement is those cash flow gaps are likely going to change, and they're going to change in some cases very significantly as you go through these different phases, especially if you're going to retire early. Maybe you don't even have the option to turn Social Security benefits on yet, or maybe you're waiting for a pension to kick in. You might have some higher expenses in the early part of retirement. Maybe you've got some higher healthcare expenses because you're waiting for Medicare to kick in, and so you're having to go into the exchanges, and that's costing you a lot of money there. Or maybe you're still paying off a mortgage, you still have kids at home in the early part of your retirement. So either way, you're going to want to know and understand what those retirement gaps are. And again, in the early part of retirement, generally we see those gaps larger. Another reason for that is hopefully you're maybe going to spend a little bit more money in the early part because you're young and you've got a lot more time and energy to be able to do more travel. So maybe you're going to front load a lot of that travel on the front part of your retirement. So that may be some bigger gaps there that you want to accommodate as well. So knowing what your gaps are is really the most critical part of this, and understanding how those gaps may be changed through time. Real quick, as a side note, something I've talked about in many other videos and you've probably heard before, be thinking about the 4% rule as a generalized rule of thumb to say that whatever the value of your portfolio is, whether it's $1 million or $2 million or $5 million, whatever that number is, be trying to limit your retirement withdrawals to 4% or less. If it starts going above 4%, it starts to get, probability-wise, it starts to get much more difficult to maintain that and have a good chance that money's going to last you for the rest of your life. So 4% I like to use as a rule of thumb, but I think it's the upper end of that. Now, if you are going to retire early and you are going to have some bigger gaps early on, sometimes that 4% gets violated and you go above that for a little bit. So sometimes what I like to look at as we're doing retirement planning is really almost separating retirement into two phases. What does it look like after your retirement income stabilizes, your income and expenses that is, and what does it look like in that early part of retirement? So as you're mapping this, you might want to say, okay, at age 67, here's what my gaps are, and whatever that gap is as a relative percentage to your portfolio. You want to make sure that's under 4%. And then if your gaps are bigger in the early part of retirement, you might want to go through and just really add up. If you're retiring at age 60, for example, you're going to have 7 years of that early retirement, and go through and look at if there is any income coming in, what that is, subtracting what you think those maybe bigger expenses are in those first 7 years, and look at that separate and say, okay, if that number is $800,000 to fund those first 7 years of retirement, then you might want to have that $800,000 kind of sectioned off and invested pretty conservatively, because that's going to be something you're going to be drawing from relatively quickly. And then that full retirement age amount that you're going to have at age 67, you can say, okay, if I need $80,000 a year for my gap after age 67, well, the simple math of that is that you need to make sure you have at least $2 million in the portfolio by the time you reach age 67, and that's going to give you that kind of that bottom line number for achieving that 4% rule. Ideally, you'd like to have a little bit more than the 2 million, but that would be at the very minimum the amount that you would want to have in there. So knowing those gaps is very important. And then the idea of the bucket strategy really is to sort of create a buffer, something you may have heard the term of sequencing of returns. So when you're still working and you're still investing before you're starting to take money out of the portfolio, you're in what's called an accumulation phase. And there, during the accumulation phase, the average of returns is really the thing that matters the most. So if you're getting a 7% average or an 8% average, even though the markets may be going up and down, and some years may be in the double digits, you may even get years like we've had over the last couple of years where the market does very, very well, and then other years where the market goes negative, because you're constantly adding money to the portfolio. You're doing something called dollar cost averaging, and you're buying more shares of the investments when the markets are low and buying fewer shares when the market's high. But it's that average return that really matters. But in retirement, something called the sequencing of returns is something that matters even more. And that's really how that 4% rule kind of came to be, is looking at that from a statistical or probability standpoint, and looking at the possibility of going through some of those sideways markets or market downturns. And especially if you get one of those market downturns in the early part of your retirement, it may be very, very difficult to be able to recover from that. It might be impossible to recover from that. So the idea of the bucket strategy is to create a buffer where you have some money that's going to be invested in some more conservative assets so that it can get you through, hopefully, a market downturn. Now, real quick, there's no guarantee that creating this buffer strategy is going to be a long enough time for you to float through that entire market downturn, because some market downturns historically have lasted for a decade or longer. And we've seen in just the last 20 years, we've seen at least one of those instances where, if we go all the way back to early 2000 when the tech bubble peaked, we had a market downturn that lasted for 3 years where the market lost about half of its value. If we're talking about S&P, from 2000 to roughly 2003, the market came back, and by 2008 had recovered back to the peak that it was at in 2000. But what happened in 2008? Well, the great financial crisis happened, the whole banking collapse, and the market proceeded to lose about 57% over the next 12 to 18 months or so, going back down to a lower level than even what it was at the bottom of the tech bubble. So just as you got back to even, the market started to go down again, and then the market finally bounced back, and by 2013 was at the same level. So you basically had that entire time period. It was 13 years where, looking at it on early 2000 all the way through 2013, the market was basically at about the same place, with two over 50% crashes in the middle there. So the idea is that as you start to understand what your retirement gaps are going to be, bucket number one, I believe, should have about 2 years of your anticipated cash flow needs, and something that's going to be very conservative, usually money markets, checking and savings accounts, maybe some short-term CDs, FDIC insured treasuries would be into that category, but just things that are going to be very liquid and very safe would be the idea there. Bucket number two, we can start to maybe still want to be very safe, of course, but we can start to maybe add a little bit less liquidity. So you could do something like a CD ladder. So you could ladder out a 5-year CD ladder where basically a CD is coming due every year and you're rolling those over. And you want to have, like I said, about 5 years in bucket number two is generally the acceptable rule of thumb there. And the idea is that if the market does go through a downturn, or when the market goes through a downturn, you're going to basically go through maybe those first 2 years and maybe even the next 5 years worth of cash flow. And hopefully by the time by the time those buckets run out, the market would have recovered by that time. Bucket number 3 is going to be your growth bucket, and that's the bucket that's really designed to be the long-term bucket. It's designed to keep up with inflation, because buckets number 1 and bucket number 2 are probably not going to give you very much growth, and they're not going to really probably keep up with inflation. So at the very minimum, as you approach retirement, I usually recommend doing this maybe 2 or 3, maybe even 5 years before you retire, is to start really positioning your assets and really filling up these first 2 buckets. If you think about it, if you know anybody that maybe was planning to retire or did retire right before 2008 when the great financial crisis happened, or right before the tech bubble back in 2000, then those people, maybe if they didn't plan for this, they had to very significantly change their retirement strategy. They might have seen a 401k become a 201k. They lost half of their value if they weren't careful, depending on how they had that money invested. So by positioning these assets maybe 3 years or 5 years before you retire, it's going to give you a little bit more of that buffer and a little bit more of a safety net, so that you can still retire when you want, because you've got those buckets filled up there. So at the very minimum, you want to have that 7 years. But if you're a more conservative investor, you might want to have a little bit more money in buckets number 1 or bucket number 2, or that growth bucket maybe isn't all equity, but maybe it's a 60-40 portfolio or 70-30. So you still want to manage this within whatever risk tolerance you're comfortable with, and that's going to be different for everybody. But even if you're an aggressive investor, because we can't determine when the next market downturn is going to come and how significant that market downturn is going to be, or how long it's going to last, everybody, no matter how aggressive you think you want to be, you should have bucket number 1 and bucket number 2 filled up and really there for that safety net. So now let's move on to the next part. So how do you manage this? Because this is something that we get a lot of questions on, and people don't really understand, because they think, okay, I've got my 7 years set aside, and they think, okay, well, that's going to get me through 7 years, and 7 years from now, I'll go back and refill those buckets. Well, the idea that I want to recommend for how to manage these buckets is really to always keep bucket number 1 and bucket number 2 topped off, because again, we don't ever really know when that next market downturn is going to happen. So I would say at least once a year, but for many people, you might even want to do it a couple of times a year. So as the markets are doing well, you're going to want to constantly take money out of that growth bucket and sell those things off as those assets are hopefully going up in value, and keep those buckets 1 and 2 completely filled up. Maybe there's some interest that comes over from bucket number 2 and helps to replenish bucket number 1. But again, even if it doesn't fill up that first bucket, then you're going to still want to take some money out of that growth bucket and refill bucket number 1. And then when that market downturn does happen, now you've got the full 7 years available to you to be able to hopefully ride through that market downturn. But like I said, real quick, again, this strategy is not something that's going to completely eliminate risk. It's just something that's going to hopefully create that buffer. I mentioned the lost decade, as some people refer to it, 2000 to 2009, even kind of extending out to 2013 before the markets got back up to that high point that they were at in 2000. But if you look historically, we've actually been pretty blessed with a very good market for most of our adult investing lifetimes, because the market really started to do very well when the baby boomers really kind of started to enter into the workforce en masse in the early 1980s. So from 1982 to 1999, those 2 decades roughly were 2 of the best decades that we've ever had historically for the stock market. And besides the 1987 stock market crash and maybe a couple other little blips in there along the way, there was very little negative volatility in the market. So we were very fortunate to get some very good returns for about 2 decades. And then that 2000 period happened. And so I think a lot of investors maybe falsely look at this and see that 2000 period was maybe the anomaly from the norm, in other words. Again, this strategy is not something that's going to be able to completely eliminate the risk of potentially going through a market downturn and having the financial assets that you have in those first two buckets running out before the market is able to recover. So I talked about earlier in the video about that lost decade from 2000 to 2009 and really till about 2013 till the market fully recovered from that. That one period of time is something that sometimes people look at as the exception to the market and not something that's more normalized. And that's because for our investing lifetime, most of us, our clients and myself, we've been investing maybe since the early 1980s. And that period from 1980 to 1999 was two of the best financial decades ever for the stock market. I think we were running close to almost a 20% compounded rate of return for nearly 2 decades. And we got used to that. We had the stock market crash in 1987 that many of us remember as one of the big drops in there. And there's a couple other blips along the way, but for the most part, that 20-year decade saw very little downside risk. And so when we got to that tech bubble crash in 2000, and then we bounced back, we even had the great financial crisis. Now that that's about 15 years or so in our rear view mirror, a lot of us are looking at that, well, that was maybe more of the exception. The markets just go up and up and up. We had the COVID crash in 2020, and that went down very hard, but then because of a lot of stimulus and government intervention, they put so much money into the financial markets, the markets bounced back very quickly, and now we're back up to those new all-time highs on most of the major market indexes right now as I'm filming this video. So I just want to point out that we got to look back over longer periods of history. When we look back over 100 years of stock market data, there's been many periods of time that lasted 15 years. I think even the longest sideways market was about 25 years. It encapsulated the Great Depression, which was one of the most significant downturns that we've ever had in this country for the financial markets. But just know that there is some risk still with this because we don't know what the markets are going to do. There's still a lot of uncertainty with this. But this bucket strategy, I think, is a very good start to being able to create that buffer. And again, depending on what your risk tolerance is, you may want to have a little bit more on that front end in those first 7 years. You may want to even extend that out, maybe have maybe almost a full decade of cash flow needs in something that's going to be a little bit more conservative. Or you can actually treat your growth bucket a little bit more conservatively as well, like I mentioned earlier, maybe having some more conservative assets there. You could include things like dividend paying stocks as a part of that growth portfolio, and those dividend stocks may be something that could help to refill buckets number 2 and bucket number 1 because you've got some constant money coming in from the dividend. So it helps to kind of lower some of the risk of that portfolio. So anyway, there it is. That's the bucket strategy. This is something that is becoming pretty widely used across the financial communities, but a lot of times people don't really fully understand how those buckets work and what the strategy really is. But again, it all comes back to really understanding what your retirement looks like, what those retirement gaps are, because if you don't understand that and you're kind of winging it, then you're probably not going to have that money set aside for when you need it for those cash flow needs, and you're going to be forced to have to sell money from the growth bucket. And that works all very well and good when the markets are up, not a big deal, but when we go through that downturn, now you're having to rethink things and you're having to potentially sell things at a loss. So that's really what we're trying to avoid here. But anyway, that's it for this video. I hope you enjoyed it. As always, if you like the video, be sure to hit that like button. If you haven't already, subscribe to our channel. We're continuing to put out videos on a regular basis here that I think are going to be helpful for you if you're planning for retirement, trying to figure out tax strategies. We talk a lot about Roth conversions, really optimizing that retirement for people, individual investors, and be sure to check out moneyevolution.com. And like I said, we're really building out a nice financial education hub over there. So that's it. I'll see you back in one of our next videos. Thanks.